Welcome to a tactical brief on Apple, the investors, speculators and traders. The resident teenagers in my house told me to get lots of views you have to do an unboxing video, Dad. So I said, okay, let's do an unboxing video. But we're not unboxing this nifty tool. I had to wait, by the way, 4 weeks to get it from Apple. We are making an unboxing video about the future development in Apple share price. So how's the situation today? Apple is trading around 430, just showed fantastic earnings figures, announced a 4-to-1 stock split. The future couldn't be any rosier. Or could it? One of the old-fashioned valuation tools I love to use, and I call it, it's something like the cheeseburger of valuation tools, is the price-earnings ratio. What does the price-earnings ratio tell us? It simply says the earnings of a corporation in relationship to its stock price. So if you have a price earnings ratio of 10, for example, this would simply mean that the current earnings have to earn for another 10 years to justify the stock price, that you could buy with these earnings the share as it is trading at the moment. So where are we with Apple? With Apple we are, whomever you ask, somewhere between 32 and 33 times earnings. So if you buy an Apple share at the moment, Apple would have to provide these earnings they do at the moment for 33 years to justify the stock price where we are at the moment. Okay, that in itself is neutral. It could still go higher, it could go lower, but what tells us, is that the right value? Is the valuation correct or is it not? So it always helps to look into the past. And in the past, we see a different picture. Yes, Apple had a fantastic performance for the last 10 years, but the median of price earnings ratios was at 15. What does that mean? 50% are above the 15 threshold and 50% are below the 15 threshold. So in this matrix, we're already quite high at 32%. Where was the low? The low was in 2013 at 9.9. And I remember looking at Apple at the time, being already a big Apple fan of Apple products at this time myself for years. Apple was trading like a steel mill on the verge of going out of business. Nobody wanted out the share. Oh, the share price, by the way, was 55 around this time. Now we are at 430. So the question is, how do we frame this whole thing? Where are we at the moment? The market is always a manic depressive. If things are bad, then the outlook for the future is horrible and things couldn't get worse. If the market is in a good mood, it's fantastic. As it is at the moment, it will always stay into the future and nobody can even consider that things might change back to a statistical normal level. And that's what we see at Apple at the moment. Everything is looking rosy. Everybody's holding Apple. Everybody has seen this fantastic rise, especially since the beginning of the year. Even better when you did it like, what did we laugh about the Robin Hood crowd? Yeah, they started accumulating Apple at 240. Now they've made a nice performance in this time. So maybe not so stupid after all. But one consideration we should have an eye on is liquidity and interest rates. You might say, yes, in 2013 we had interest rates over 2%. Did we really? Have a look at the real interest rate. That means inflation-adjusted interest rates. We are at the same situation we can see at the moment. Does that induce us to do anything different? Then the average growth rate of Apple earnings is between 13 and 15%. I grew up, and maybe I'm too old, and that rule doesn't hold any true anymore, that the growth rate should somehow be in line with the price earnings ratios we see. Price earnings ratio is 32, growth rate on average 15. We might have a huge recession coming up. We're already in one. The question is, will this recession turn into a depression? I can't tell you. But there's a probability to do that, and we have peak valuations at Apple at the moment. So what is the tactical situation? What should we do? And as so often, the option market gives a very good indication. In normal markets that are not bubbly, you see usually a situation where puts are more expensive than calls. And this expensiveness is being measured in implied volatility. What we see at the moment in Apple is that calls are slightly more expensive than puts, which is anomalous. How is that? It's supply and demand, of course. And we've seen a 6-fold increase in stock option call buying by the street crowd on Apple. Where do they buy this? They buy these calls at market makers. Market makers will therefore increase the prices for these call options. Volatility, implied volatility is rising. So market makers suddenly are short the upside. And that's where the bull market fuels the bull market. As long as the market is rising and the street keeps on leveling up, the market makers will have to buy shares. This will eventually end without any question. Nobody will ever sell the top or buy the low, but we are reaching a top level here where the market provides us with a beautiful tactical situation to reduce holdings into a still strong market which is able to absorb the supply that might come out. Obviously, at the moment, nobody believes that Apple could ever go down because all major money managers have to hold Apple. Yes, and they will hold Apple. They're not going to sell their holdings. Roughly 60% is in the hands of professional money managers, 5% is in the hand of normal industrials, and then we see another 35% which is in the hands of the street. The street will make the market, and the street is very, very price sensitive. The moment Apple stops rising, there's no need anymore for the market makers to buy it even further up. And one of the tools where you can see it's called a gamma distribution, simply tells you what market makers have to do. Usually on the upside, they are long gammas. Long gammas simply means the market gets sticky. You approach a certain level and then it stops there because market makers have the fuel to buy and sell shares always in the right direction, at least for them the right direction. Markets go up, they can sell a little bit. Markets go down, they can buy a little bit. So the market tends to firm around one level. If market makers are short, and an indication for that is the skew. When the calls are more expensive than the puts, they have to hedge their positions. They have no opinion on Apple. What they have to do is, if markets go up, they have to buy. If markets go up further, they have to buy more. So what is going to stop this relationship? When we see a sideways market or all these options currently at top levels tend to expire and the Robinhood guys take money off the table. Well, nothing's ever different. I've seen that before in 2000 and the market for me at the moment smells a bit like the beginning of 99. Smart money knew already that we were in a valuation scenario which was not sustainable. However, the market did another 30%. Different topic, but what we can see now in Apple is this beautiful situation. The market is sustaining, taking in a lot of liquidity. And if you've made these huge performance increases through your portfolio, the only thing I'm asking you, consider in a valuation scheme, in a longer term valuation scheme. Was Apple cheap at 9 with all the growth still in front of it? Or at 32, do we still see this enormous growth rates in front of them? And does this PE correspond in any way, shape or form to the average growth rates Apple did display on a political situation? Where's the growth coming from? It can only be organically. They've just been quizzed in front of the Senate. So purchasing smart, innovative firms for the future, which could generate this growth, is going to be difficult. It has to be organic, this growth. And maybe I'm not seeing it, but it's a good company. The question is, will it justify the growth rates, or will it deliver the growth rates to justify the price earnings ratios? And the situation we see at the moment in the market actually inclines me to reduce positions, take advantage of what the option market is providing right now. Thank you very much. I hope you enjoyed this video and I hope to see you soon.